Hey guys, this is Mike Jordan with Unique Wealth Education. I'm happy to have a special guest on the show today who is actually a mortgage note investor. He's incredible. He's one of the guys I feel is one of the top guys around the country in educating people on mortgage notes, and has actually done over $1 billion in buying debt. So debt is mortgage notes. So I'm going to welcome you guys. Scott Carson, thank you for joining the podcast today.
Hey, man, I'm so honored to be here, Mike. Thanks so much, man. I'm excited you're doing this, too. This is such awesome stuff, man.
Thank you, Scott. You know, I met you years ago in Dallas, and I remember the first time I met you. You were so welcoming, so helpful, and you're someone that helped me out a lot with with a lot of things in my business. So I'm always appreciative of that. So I feel that you're such a giver. So that's why a lot of students that are in your mastermind and listen to you on your podcasts and your webinars get so much from you. So this is great to have you on here, and some great education that people are going to get. So Scott, tell us about your business. We know that you're mortgage notes, so tell us about your business. Give us the meat and potatoes of your business.
So I've been an active real estate investor since 2002, since I graduated from college, but I made the transition in 2008 to just focus on non-performing mortgages. As I started a mortgage company with a buddy of mine in 2004. And then when everything hit the fan, I just stopped from the origination side and started really dialing for dollars to the banks that we're originating from, and just knocking 50 to 100 phone calls a day, trying to track down anything that had non-performing assets that I could pick up, whether it was residential, commercial deals. So yeah, over the last 10 years, it's amazing. I was looking at some of the numbers. It's over $1 billion in debt that we've bought.
Wow.
Over the 1,000 plus deals. Done residential, done commercial. We've bought debt just on just about everything when it comes to real estate for the most part, and some of the different crazy deals. But our biggest goal when we buy this debt is when we buy the mortgage. For those that don't know, if you've ever got a house or got a mortgage, probably after you got it refinanced or financed, you probably got a letter in the mail that your mortgage was sold off to somebody, or your servicing was being transferred, right? Well, that's one of the assets we do. We buy these non-performing notes from banks where the borrower hasn't paid in 6 to 12 months. We buy that debt at a discount because the borrower is not performing. So therefore, once we buy that debt, we now become the bank. And then we're reaching out to the homeowners of trying to, as I like to say, instead of rehab the property, we like to rehab the borrower, if that makes sense. Okay?
Yeah, absolutely.
And our cash flow, our profits are made from getting them reperforming. It's great. We get cash flow. Then after 6 to 12 months of them paying on time, that mortgage is now considered reperforming, and we can sell that off to Wall Street again, or back to investors at 75, 80, 85% of the value. And so make a nice chunk of change there, because we're usually buying, the mortgage, like I said, 30 to 50 cents on the dollar. Now, I wish that happened all the time. 50% of the time, we're still end up having to take the property to foreclosure to take the property back because the borrowers don't want to work with us. But we buy in a variety of states. Love your backyard. Michigan is great. I got to send you some lists of assets there actually right now.
Love to see them.
Yeah. Ohio, bought a lot of stuff in God's waiting room, or as we like to call Florida, over the years too. But we just, I have a big passion for helping people. When I was first into real estate, I lost my ass in a couple deals. Was lucky to get my assets out of a sling, and I always promised that if I were able to make it, I would be glad to help anybody along the way. And so I was very fortunate during those 4 years of the mortgage company. I had a mentor who was doing the creative financing, the wraparound mortgages, the buying and selling distressed debt. And so I, very lucky that 4-year period to really learn a lot about the creative financing and debt game, because everybody, whether they believe it or not, is in the mortgage business. They're in the debt game. Unfortunately, most of you are making the payments the wrong way. You're paying them out versus them coming in. So we're all on paper, where if you got a mortgage, a truck payment, student loan, credit card debt, all that stuff is paper. And we just happen to play in the residential and commercial mortgage space.
Well, that's amazing. That's amazing. Actually, you answered one of the questions that I was going to ask you. I was going to say, hey, so what percentage of the mortgage notes that you buy reperform? And like you said, when they don't reperform, what happens is you go through the foreclosure process. and your collateral is the asset. So a lot of people, when I first got into buying notes, was around 2012 and 13. And, I bought mortgage notes. And one thing I always felt comfortable about is that worst case scenario, I get the home back. I have collateral there. So I've done about 100 note deals myself. And, I pick up some through the funds out there that send it out and take a look at it. And the way I'm always looking at the deal is worst case scenario, if I get this home back, what position am I in? If I can go get it reperforming and have it, cash flow, wow, I'm doing great. I think that's where you really do well when you get it reperforming, because you got to add a percentage of the market value. And one thing that's important that I always found is that, make sure you do your due diligence, know about the first, the seconds, the taxes. There's a lot of encumbrances that come with that note, so make sure you do your due diligence. And that's one of the things that I also, listening to you teach about that, know how to do your research and make sure you get your numbers right. And that's very, very important. So
it's a different mental process than the fix and flippers are used to. If you're
Sure.
an REO investor, you've got to come from it from a little bit different spot of being the bank. And one of the biggest mistakes I made early on as a debt investor is I was coming from the fix and flip side. So I was overpaying, or I wanted to foreclose on everything because I wanted to take the property back. And that was one of the biggest mistakes I made. There's assets I could have modified, gotten cash flow coming in immediately. So now that I'm not having to put out attorney fees and then repair costs, I could have had a reperforming asset that would have blossomed. But I was too stubborn to think of it as the bank's aspect of things. But I agree 100% with what you say. Worst case, I'm going to end up with the property back. I want to make sure that the value of the property is there.
Right.
You're not going to get interior views, but you can still tell a lot about an asset by the outside and the collateral file and the servicing notes that you get. But yeah, I like it. Nobody calls Bank of America when little Johnny, flushes rubber ducky down the toilet.
Absolutely. No tenants, no toilets. So,
no trash outs.
What's that?
No trash outs.
Absolutely. Absolutely. So, I look at it like, instead of being a landlord, you're a
lien lord.
Lien lord. That's right. You're a lien lord. So I still own some of those notes that I bought from a long time ago, and they cash flow. So I look at it, how much, yeah, exactly, cha-ching, that's right. I mean, it's amazing. When you get that note and you're able to get it reperforming, you actually help the person, and you're making a lot of money. And what we do right now is we actually buy a lot of redemptions from the auction, and we talk to the people, and they redeem the house, and we keep them in the house. So that's a form of buying the note in a different fashion, because ultimately maybe they do a deed to the home for you, and you turn around and you actually could either land contract it back to them, write a mortgage, or you could do a lease option with them. So it's a very, very, very interesting business, and it's really pounding the pavement and really seeing who has that debt out there. And a lot of people are scared of it because there's a lot of variables to notes, as you would agree, correct?
Yeah, you're 100% correct. There's a lot of different variables with a borrower, with the payment streams. You got to look at what they owe, how many months behind are they working? What's the existing market rent rate compared to what their mortgage payment is? Does it make sense for you to modify, or do they just need them to reinstate? I mean, I always make the joke that every note is its own country western song. You never know which way it's going to go.
Yep.
Choose your own adventure kind of deals. But you can still put a lot of streamlining systems in place so that you're going after the same thing. So like I like just targeting occupied assets.
Right.
I find out a property's vacant, it doesn't help me, because then I know I'm going to have to do rehab on it. I don't like to do that. I want to travel. I want to work from Austin, where I live, or travel and do some stuff. So that doesn't mean I'm not doing rehabs. It doesn't mean I'm not doing things. Like I just paid a tax bill on a property in Flint just 20 minutes ago, actually.
Yep. So you don't lose the property because the taxes go with the property. Yep.
Exactly. So I'm avoiding losing it because the borrower's still in it and they've been making some payments and some things. But the thing, I want to tell people, there are a lot of variables, but honestly, what you have to realize is, not bashing anything else, is that the banks are the biggest entities out there.
Right.
They're in the business of making loans and that cash flow. They don't want to own real estate. They want to own the debt aspect of it. And so if you can get into the debt game, you're going to see deals 6 to 12 months than most fix and flippers or REO buyers and things like that, because I get lists in from banks on a regular basis that may have 50 assets every month or 400 every quarter or 2 or 3 every month. It's just that we've built relationships with these asset managers at banks that now we've got stuff. Now I'm not having to do a lot of the marketing, the postcards, the door knocking. There's nothing wrong with that. Done plenty of that in my day. It's just that since I'm buying in a variety of different markets, I can target those banks, and also, hey, instead of buying one asset from a borrower or dealing with an individual person, I'm looking at buying 100 from a bank every year or every quarter if I can.
Yeah, I want to point out a couple things that you mentioned here that are really important. So, Scott, you're very focused on notes. You're not a guy that does, some notes, some fix and flip, some wholesale deals, some rentals. You're very focused on notes. The best note you can buy is an occupied home that you can go remodify. So that's your focus. And you focus on those. You probably steer away from the vacant ones, which I don't personally. I'll take them occupied or unoccupied because I can take them and fix and flip them. So it kind of is, my multi-prong approach towards purchasing. So I put it as a funnel for me to get some deals. So if every year I get 20 deals from notes that I fix and flip, great. So that's one important thing, that the focus that you have is incredible, and which is probably part of a slice of the pie of why you're at where you're at today, which is really successful, incredibly successful, because you're focused. Another point I want to bring up is that, people that own notes, you got to remember that, you could lose that note. You can lose that house to tax foreclosure if you don't pay taxes. So Scott just mentioned he paid the taxes on a home that he owns in Michigan because the taxes are due, I think, at the end of March. So Scott,
it's due on Monday.
Yeah, it's due on Monday. So Scott made sure, if you didn't pay it, you lose that house. So that's important to know. And in this overall process, Scott has, I think you've showed it or I've seen it before, he has a process map. And that process map actually shows you everything that could happen in the course of owning a note. And if this happens, you got to do this. If you do this, this could happen. If the person is in bankruptcy, you're going to collect from the trustee. If the person, you could offer them cash or keys. If they don't want to do that, you could offer them a remodification. If they don't want to do that, you got to foreclose on them. So what's important is to understand that it's like a giant process map, which you're playing a chess game, and Scott is really, really, really incredible at playing this chess game. So that's huge.
So I love, there's a map. If it goes this way, then you have these options. And if it goes this way, you have these options. Yeah, if anybody would like that, they just can email me, and we'll have the email address. I'll be glad to send that process map for free. But
yep, and we'll definitely get your contact out at the end of the.
Yeah. So I am in Austin, Texas. I want this to be very, very clear on something. I'm in Austin, Texas. Very hot, I think, overpriced market we were talking about before we got started here today. I haven't bought anything in Austin in a decade. I mean, I have bought most of my stuff outside of my home market. So I don't want to deal with contractors because I don't want to rehab properties from states away. Now, the only state that I really like doing rehabs in, if it was in Texas, other than this, would be like South Florida, because I have a great team on the ground there.
Sure.
You have a great freaking machine of a business. I had a little bit of peanut butter and jelly when I came to your offices. I'm not gonna say I was not turned on. I was turned on by your operations. Smooth operator, you.
Thank you very much. I appreciate when you came in here and you took a look at my operation. For someone that I respect as much as I do you, Scott. It was such a compliment for you to say that, because I've worked hard on building the systems and the processes up, because ultimately what we want to do is we want to deliver a service to our clients, which is our buyers, people that invest with us, and that's returns. We want to deliver the highest returns possible, and we want to have the best communication possible. And that's why I really appreciate that kind compliment. I really do.
Well, I mean, you do. The beautiful thing is you know your market, and that's what's great is you've
You
brought in, you know
focus.
your pie, and you know you're going to get probably 20, 30 deals a year from the note space because you're focused on your market. And I mean,
Exactly.
and you do fix and flips. You're not afraid of vacant ones because it's in your backyard, which is great. Me, it's different model, and that's what I love about note business is you can tweak this for whatever you're focused on. Now, if you live in California, I'm sorry, you're not going to see a lot of notes out there.
Right.
It's a land of everything's overpriced there. But if you're in Michigan, Ohio, Indiana, Illinois, the Carolinas, there's often plenty of deals in your backyards. That's often all that you've got have to focus on for the most part.
Absolutely. And I look at it like you take fix and flipping, wholesaling, buying, hold, and really to get the deals, it's a multi-pronged approach for our company. And what we do is, from the postcards to RVMs to text messaging to, dialing for dollars to, MLS to, dealing with wholesalers, auctions. You really have to dig for those deals. With your business, you have those relationships where they're constantly going to send you over the inventory and you pick and choose. You've built those relationships up where they know you're going to perform, you're going to close. And that doesn't happen overnight. Banks don't just send people lists overnight. You got to prove yourself to them because they'll be wasting their time. So they ultimately, you're doing them a favor. You're getting the debt off their books, and the banks aren't in the business of going and knocking on doors and this and that. Sure, they'll try to remodify and whatnot, but not like you. So tell me, what is the difference between the bank remodifying and you? Why do I just mentioned they want to get the debt off their books, but why do they ultimately sell it to you for such a discount?
So it's all about time value of money and the velocity of capital. So banks, for them to take a property back and then to put it on the MLS and to fix it, based on how big and bulky they are, it's going to cost them 2 to 3 times what it would cost for somebody like me or
Right.
you to go out there and rehab it. So a bank would much rather settle for 40 cents on the dollar now versus having to wait 6 to 9 months to foreclose and then go that route. It's like a bird in the hand. Oh, I can get 40 cents on the dollar. We'll take it because now they can take that 40% and now loan it out 5, 10, 12, 20 times in a year to recoup up what they would have lost on that note. So, I've been buying direct from banks since 2008, 2009, and it's not as difficult as most people think it is. It's easier actually now to get direct to hold of bank contacts and asset managers. Banks really just want you to buy something and fund. They don't care where the money comes from. Oftentimes they're not requiring earnest money. They just want, hey, here's a tape. You got, make an offer, accept the offer. Okay, great. You got 30 days to close or 2 weeks to close. That it's a beautiful thing that way because it gives you some opportunities to raise capital as you need to if you don't have any capital yourself and be able to market that asset to your database to help raise the funds. But the reason banks want to send it to us at a discount because people ask, well, why wouldn't they just do it themselves? They don't have the time. Think about this. You ever called in and talked to loss mitigation at a bank? Their call centers. You got somebody who's a $15 to $17 an hour employee who doesn't really care. They're overstacked with files for the most part, especially if they're short sales. They don't care. They're just processing through. It's not their money on the line with the banks. So the banks have realized that, hey, let's get this thing sold ASAP. This is why if you ever go late on a mortgage, why your phone starts ringing nonstop or the mailman starts knocking on your door to deliver a certified letter to you. They want to reach out to you and make that right party contact so they have a solution. They have something they can work on with you sooner than later. You look at other things too, like the value of the asset too. I buy a lot of sub $100,000 mortgages. People in houses that are 75 to 150 grand maybe is our bread and butter. I don't buy a lot of high end because I want to deal with a homeowner that I can really negotiate with.
Sure.
Higher end assets, they're going to have people with friends that are attorneys and lawyers that can drag foreclosures out. So I like dealing that bottom. I won't say the bottom of the barrel. I don't like to buy anything below 25, but I add value to the banks because they can move that lower valued stuff off their books, which is really just eating up in fees and taxes and other things.
Yeah, recently I seen, I think it was about a month and a half ago, I seen a deal that, one of your students got, and, you showed them how to get to the asset and whatnot. And, they showed me the deal, and I was like, how much did you buy that for? And they told me, and I'm like, You bought that for that much? I'm like, that is an amazing deal. And like, well, we have a formula that we use. I know that you teach people how to use a certain formula, and their return on their investment is great. And then I told them, I said, hey, listen, if you go to foreclosure, call me, I'll buy it, And then, they could sell it, they could wholesale it, they could put on the MLS, whatever they want to do with it. So, really it's about buying right. I think that you really make your money, just like in real estate with notes, on buying, for the right price. So when you say 40%, are you saying 40% of the value or 40% of the UPB, which is the unpaid balance?
That's a really good question, Mike. I'm glad you brought that up because it varies. So I'll give you an example. If the borrower owes 120 grand and a house is worth 100, okay, we're probably not going to offer more than 50 cents of the as is value. So that'd be like 50 grand. Well, 50 grand on a $120,000 mortgage it's in the 40s, right?
Yes.
40% roughly. So it varies. I mean, we don't usually go above 50% of value of as is value of the house is usually our highest point that we offer on right now. Now, if they don't owe, if they only owed 50 grand on a $100,000 mortgage, then we would drop it down to like 50% of the unpaid balance. Whichever is less is a good starting tool. That doesn't mean we always end up there. Sometimes we're below that. Sometimes we're above that. Looking at how long it takes to foreclose an estate, how many payments the borrower's made in the last 12 to 24 months. So it's not hard, fast pricing all the time. And I call it kind of fuzzy math because you have to take a lot of considerations into place. Has legal been started? Has it been serviced for a while, or has it been sitting on somebody's books and nobody's been touching it? What's the neighborhood look like? What stays on market? There's a lot of variables that go into what our bidding aspect of is, but
it's not cut and dry where there's just one way to do it. And that's the one thing with notes. You really got to plan and understand the different, situations. Like you said, maybe in wintertime, you're more likely to, make a different move because homes move slower on the market, in certain states. So you may be more likely to, work with the homeowner there and maybe work out a payment plan instead of going to foreclosure. I mean, this is something that's popped in my head because I know that 40%
right.
rule.
Yeah, 100% right. Because especially in the upper states where it gets a little cold, and you had a few cold days up there this year.
I don't recall any cold days in Michigan. I just recall sunshine, 85 degrees, being on the beach in Michigan. I don't recall any cold days.
There you go. So the thing you got to realize is you don't want to end up with an interior waterworks or a underground ice skating rink. You know what I mean?
Yeah, of course.
This is part of the reason we also just go after occupied assets. There's usually somebody keeping the heat on, paying the utility. Also, the air conditioner doesn't usually leave the house, or the copper goblins don't show up on an occupied house like they do in a vacant house. So those are
or the furnace doesn't grow legs and walk out.
Exactly,
so.
Exactly.
Oh, that's funny. That's funny. So yeah, no, that's interesting because I just want people to know that it's not so cut and dry where 40% means just 40% of value. Like you said, sometimes it's 40% of the lesser, right? And so you just have to learn it. You got to understand that there's a lot of variables in there. So you said, I look at it like there's a lot of lenders out there that, produce notes. They're hard money lenders or institutional lenders. That really is a note business too, because
it totally is. Yep.
I actually, I buy some notes from, lenders that have foreclosed or that were hard money lenders, and the person didn't pay. I buy the note, or what I do is I buy the asset after they're done with foreclosure. So it's important to understand the entire process. And what I mean by that is, you have a home, right? There's a mortgage written on that home, and then there's a process that goes on. That homeowner pays or that investor pays. If they stop paying, it becomes a non-performing note. And that's what Scott is a specialist in, is that point in the market when the note becomes non-performing because he's buying it at a discount, and there's a huge opportunity out there. So listeners, you think about real estate, he's hidden a certain niche of the market right when a note becomes non-performing. In defining a note, it's a mortgage note. It's a mortgage. It could be a land contract. It could be a deed of trust, but it stops performing, and he sees the value in it and buying it at a discount. Is that correct, Scott?
It's totally correct. Now, give your audience some numbers here. Like in 2010, at the worst time in the market, we had 15 million homeowners were underwater, where they owed more on their house than what it was worth. Great time, bought a lot of stuff. Biggest mistake I made was not buying more. Okay. Today, fast forward, we're 9 years. A lot of stuff's been cleaned off the books, but we still have roughly around somewhere between 3 and 5 million homeowners that are still underwater.
Sure.
They still haven't been foreclosed out. It's been dragged on. Their mortgage has been sold a couple times. And what's scary to think is that today we still have about a 4% default rate, but literally 1 out of 10 Americans are already a month behind their mortgage. Wow. 10% of the country is a month behind. Now, that doesn't mean they can't get made up. It's not that a bunch of those weren't government employees that were laid off or weren't getting paid for a little while. That happened, but that's a scary number to think about, because when you start thinking about the other forms of paper, the auto debt that's at all-time highs and defaults, credit card debt, student loans, medical bills, we've got a lot of distressed debt out there. That's just not not the mortgage debt, but a lot of people there are trying to, rob from Peter to pay Paul. They've ridden that that increase in their value up and then took out a line of credit to buy some stuff. But what's going to happen when the market turns south again? Well, I don't know. I don't have a crystal ball when that's going to happen, but when you see things that were going on 10 years ago, like I'll give you an example here. You've heard of a little thing called subprime mortgages, right, Mike?
Absolutely.
Top flight mortgage in Flint was one of the biggest sellers of that. Was like default, like ground zero. Well, they got really creative, the bankers did, and they came back with a new name for subprime. It's now called non-prime mortgages, okay? And there are lenders doing non-prime 100% financed in all 50 states now. And it's been going around for a couple of while. So it's not brand new to the market. They've been around for a while. But I could go online right now and look at and pull up the lending programs and see that they're lending 100% like 520 FICOs. 100% with a 520 FICO is somebody who should not be in a house. They have no motivation. They're not paying their bills on time already, but let's give them a mortgage. And that's just going to end up in default in 6 to 12 months. And so I track that stuff to who's creating that, who that company is selling those mortgages off to. And that's who I track to find deals, 6 to 12 months down the road.
Big tip there. He uses data to find his deals. Thank you for that, Scott. That was a little bell there for the audience, because data is important. Knowing what's going on in the market is important. We actually earlier, I had a call recently, and actually was on our podcast with a gentleman named Dave Steck, and he talked about you have approximately 400 MSAs in the country. And 100 of the 400 MSAs is experiencing a softening or a declining market. So what does that mean? That means that, eventually there's going to be more bad debt. People are going to, there's going to be, people that are losing their homes. It's always going to happen. Right, Scott? This is not something that is, when the market's hot or the economy's hot, there's still bad debt. There's always someone, unfortunately, losing their job, or something bad happens and they don't pay their mortgage or whatever it may be. Well, just be ready. I think that preparation, when preparation meets opportunity, that's when success happens, and that's where you could buy some really good notes, and that's what Scott prepares for. And I think another point I want to bring up is I look at it like, Wells Fargo, Chase, Bank of America, all these major banks, they don't want to be the big bad wolf that goes and forecloses on people, because they want that walk-in business, that deposit business and whatnot. So they sell their mortgages, right, Scott? So if they're in default, they're most likely going to sell it, as a non-performing loan, and it'll eventually get to someone like you, and they won't look as bad, and what they'll do is they'll write it off against their profits. Is that correct?
Yeah. So Bank of America, Chase, the bigger banks, they're not going to sell a one-off note. They'll sell
a tape.
They'll sell a tape, what we call it, or a tranche. but it's like a $50 million portfolio of
Sure.
distressed debt that they're selling off. So guys like me aren't going to buy from those guys. But who they sell that tranche to, those $50 million that's may get sold to one company who splits it up 3 or 4 ways, and they keep the top 5 or 10% and sell the rest off. And so I'll come in, maybe I'm buying a 3-1 or 2-1 or 2-2. It's not the 3-bedroom, 2-bath, 1,500 square foot house or greater built after 2001. I might buy something that's built in 1949.
Sure.
But as these pools get chopped up, there's stuff that's the very bottom of the barrel that really doesn't make any sense. But the banks will give that stuff away a lot of times. When it's like I bought a 2-bedroom, 2-bath townhome on Jefferson Drive in Baltimore for $7 a couple years back. It was boarded up.
Why would you pay so much? I mean, Scott, you overpaid. Really, you could have got it for $6.
I wholesaled that the next day for $5,000 to somebody who wanted to come in and fix it up. You know what I mean?
Absolutely, absolutely.
But that's the thing is, and Fannie Mae came out a couple of years ago and talked about, if you ever bought a HUD foreclosure and things like that, there was a lot of them. Well, I think 3 years ago, they came out and announced they'd stop really selling the REOs because they're selling most of their stuff off in portfolios to investors like me, because we have a lot more flexibility than they do. We can be creative in that loan modification and make it work for us. Whereas the bigger banks, the bigger you get, the less agile you are to be able to making moves, and being able to work deals out or capitalize in the market.
Well, Scott, if you look at it, a bank that sells it to you and knows, or a fund or whomever it is that took down that big tranche of, 10, 15, $20 million, or a bank that you buy directly from banks too sometimes, right? The smaller community credit unions and maybe the smaller banks.
Well, no, I don't buy. I would not recommend buying from like a small branch where it's like I've got like less than 5 branches, because they're going to be too conservative on their financing.
Right.
They can't really take a big discount. So what we do is we target your medium-sized regional banks. They're usually at least 5 or more branches, and usually a couple different states. But I have bought from Capital One. I have bought commercial assets from Wells Fargo, U.S. Bank. Who's another big one out there? Colonial Bank. Bank of the West out in California, things like that. National Bank. I mean, every bank has distressed debt. And sometimes for those that are listening that are commercial investors, sometimes buying commercial debt's a little bit easier from the bigger boys than buying. Like Wells Fargo won't really sell off their non-performing notes on the residential side because they've got their systems with Premier Asset Services.
Sure.
PA handles it. But their commercial stuff, I can go to San Antonio. I can get a list pulled on the commercial stuff all day long and cherry pick all day.
So, with the banks that you do deal with, and how do they, when you go there and your goal is really to keep the homeowner in the home, that's your strategy. I mean, that's really, it's not only your biggest money maker, but it's but it's also keeping someone in your home, which is a great thing. You kind of double dip. You're making a lot of money. You have less risk, and it will triple dip, and you keep that homeowner in their home. So, do they view it as a positive? Do they sometimes give you a better deal because of that? Talk a little bit about that.
So, depending on the size of the bank, they don't want a PR nightmare, okay? So like we were just negotiating with a bank here in Texas, a San Antonio bank that had a specific lending platform. They had like 33 loans that were in this one lending platform they did. It was smaller valued stuff that they just wanted to get off their books. They wanted to sell it to somebody as a bulk offering because they didn't want to be the bad guys foreclosing like you talked about. So they were able to discount this stuff. And 2/3 of the portfolio was performing. But they sold it to us at 55 cents of value. And there's a lot of 55% of unpaid balance, but there was already equity. So we ended up technically picking this portfolio up like 34 cents of true value.
Wow.
With 2/3 of it performing. And when you calculate what the performing yield off that portfolio, that was an 18% cap rate on those alone, not including the equity. And then the non-performing stuff, we were able to sell that off.
Probably paid for some of your performing stuff. You probably
exactly what we did. We sold the non-performing to help us buy more performing stuff, and that's one of the things that I look at when I buy a non-performing is to get it reperforming, keep it for a while. I may keep it for cash flow depending on how cheap I paid or what they're paying. But if after 12, 18 months, then we'll look to sell that asset off and then double down. One deal will become 2 deals. Those 2 deals will become 4. Those 4 will become 8. And that's kind of the way that we've built our business over the last 10 years.
A tape or tranche like that, to me, it just sounds like a home run. I mean, you just you had a third that's non-performing. You probably turn around, wholesale, and sold it. That third of the money you paid for part of the other. I mean, I don't know the exact numbers, but it sounds like you're out of pocket very little because you just made the right moves.
Yeah. So one of the things that we did, it was a 1.1 purchase price on all 32 assets. We were actually able to sell some of the performing notes off to a hedge fund the day after we closed. We had them pre-price it. Wow. So we were able to, yeah. So we ended up keeping 9 of the assets performing free and clear. The other 8 that were non-performing, we're basically selling as REOs and closing them out. We're going to come out, and making some pretty good money on that portfolio.
So that was relationships, planning, and really putting that deal together. And I mean, and that's amazing. I mean, you just look at stuff like that.
It was a new relationship. We actually used a service called Distress Pro to track banks here to see what kind of percentages. And I jumped on the FDIC.gov website to look at this bank's quarterly report. And they had an increase in their 60 to 90-day accruals. They were also increasing their 120. So we picked up the phone and called them. And
so it wasn't even a relationship.
Yeah, it was a brand new relationship from just dialing on different banks and talked to the special asset managers. No, that bank was called the secondary marketing department, is the other department I go by. Got on the phone. They were willing to work with us. Very friendly. They never sold a loan before. And it was great. They gave us initially 30 days to close. We ended up asking for another 30 to work it creatively. And 60 days. I didn't have to put up any earnest money, no money of my own out of pocket because it was all funding with other people's money.
Wow, unbelievable. Well, the thing is, there was a relationship. Yeah, cha-ching on that for sure. Probably 3 cha-chings. But I was going to tell you, Scott, in that scenario, there was a relationship there with you building, having the back end exit strategy with the fund. So you might have bought the distressed notes. Through locating it through your systems, but then you had the fund that was willing to buy it because you proposed it the right way and it was a good deal for them. So that's awesome. So when you brought up other people's money, which is, real estate investors, love to hear this. And we're, all of us are always looking for funds. I don't care if you're worth $1 million, 10 million, 50 million, 100 million. Everyone I talk to is either raising funds, doing syndications, borrowing hard money. I mean, it's smart business. So how did you raise your first capital to do your first deals?
So the way I raised my first capital, we still do a lot of this today, is I target self-directed IRA investors, people that have money in Quest or Equity Bust or Pensco. Some of those different self-directed IRA companies out there. There's like 50 different vendors that handle that. And one of the things that I do, and we still do this today, we have an assistant that does this, is if you've bought a property or lent money out of your IRA on a piece of property, it's pretty easy to track down those that are pulling the trigger. And so we'll jump on the county appraisal districts and also the county clerk in different areas of the country. And we'll just do a search by the owner name. Like here in Texas, I'll go into Harris County, which is where Houston is, and type in Quest IRA or Quest Trust Company. And it'll pull up a couple hundred people who have bought a piece of property where they're self-directed IRA. Well, I know something instantly about those people. One, I know that they've got money because they use their self-directed IRA. 2, they're real estate investors because most of the time real estate investors are the ones using self-directed IRAs. And 3, they're looking for deals to either purchase themselves or to fund. So we do that, and then we'll often find their contact information or at least their mailing address, and then we'll just reach out to them. So either via postcard or a letter or find them online and say, hey, came across your information. I'd love to visit with you. If this was a real estate deal, we're looking for more investors to either fund our deals or take down bigger portfolios. And that's where we raise a lot of our private capital. That's what I did initially. I still do that today. It's what's helped feed our fund. And it's an easy, I don't want to say it's like shooting fish in a barrel, but a lot of people have money sitting on the sidelines. And if I'm friends with Nathan Long, who's the CEO of a Quest, and they've got 1.2, 1.3 billion under management over there, but 34% of it is just sitting in 0% earning accounts, waiting for somebody to call
Yeah, they would like to put that money to work. That's for sure. So some guy comes to you as $100,000, 200,000, $500,000. So how do they invest with you? Do you give them a promissory note? Do they own that note? So if one of the listeners wants to call you and says, "Hey, Scott, you've been doing this. You've done $1 billion worth of transactions. You have a phenomenal name in the industry. We want to invest with you and make some returns." How do they? What's the process?
So it's a conversation first and foremost. What are they looking for? What's their background? What do they want with that money? Some people need to have income immediately. So in that case, if that's the case, they're looking for a return to live on. We usually just put them in like a flat return, somewhere above average return for them. I won't name any interest rates. You got to give me a phone call to find that out, but something that they were paying them on a quarterly basis, because we're constantly buying. Now, somebody who's want to be a little bit more aggressive, maybe they don't need that money for 12 to 18 months, or it's going in a self-directed IRA that they couldn't touch that money anyway. They will do, kind of put them on a JV partnership. Sure. Or they'll fund the transaction. We'll do a lot of the workouts, talk with them. I kind of call it my learn while they earn program. Sure. And then when we finish with the asset, we'll pay them back. We'll get our expenses covered second, and then split the profits up however we arrange on the front end.
So Scott, part of with me being Unique Wealth Education is I believe in hands-on training. I believe actually in helping people out on the transactions, whether it's a fix and flip, wholesale deal, buy and hold, apartment complex, note, whatever it may be. So, in the future, I may have a lot of people that want to say, "Hey, Scott, can we, do a JV deal on this and walk through the deal with you and fund the deal?" Would this be stuff you'd be open to, and then kind of, they learn and earn?
Yeah, totally. That's one of the best things that we did, because when we got started teaching years ago on how to do this, people loved us when we were sharing stuff, but they didn't know what a note was. So we would teach them what a note was and show them kind of how we walk through. They're like, "Oh, that's great. That's awesome. I don't want to do that much work. Can I just write you a check?" And I'm like, "Sure, write me a check. That's fine. We'll make sure you make a good return on investment." And we're only buying first liens. We're only buying at 60 cents on the dollar or less. We've got insurance, we've got the team, we've got the attorneys. We've got the whole system behind us to help people really kind of churn and burn if we can.
Yeah, I love the learn and earn an aspect because a lot of people invest with us and they get tons of passive income. We pay out, hundreds and hundreds and hundreds of thousands of dollars every month to investors. And, I like actually when, someone wants to learn and earn, because we could show them the process, because they could go eventually off and do it on their own. And I don't look at it as competition. I look at it as I'm building more bridges. I think success is also defined by how many bridges, do I have built. I can text you anytime, Scott, and you text me anytime. You need something in Michigan, you text me. Likewise, I do with you, and we answer each other's questions. We build that relationship that has been years. So I look at it as, when you build those kind of relationships with people and you help them make money and learn, how many relationships you have, to me, also can define how successful you are.
Mm-hmm. So that's the thing is, it's not all about who knows you, or who knows you, and your network is your net worth.
Absolutely, your network is your net worth. Be close proximity to wealth is, the closer you are with your proximity to wealth, the wealthier you're going to be. So I think that's very important. So on one of these deals, if someone wants to do a deal with you, you have a promissory note with them, because I know in a real estate transaction, we do a mortgage and they record it on the property, and we do a promissory note, and that's the way that a lender does a deal with us. With you, if they want to do a deal, they have a promissory note. Is a note collateral, or how is that done?
Yeah, exactly. Great question. So we'll do a joint venture agreement. Separate agreement talks about it, and then we'll do one of a couple things. Some people will put them on the actual assignment of mortgage at transfers. When you buy a note, it's an assignment of mortgage that gets transferred. So we'll say 50% interest to Michael Jordan or Strategy Investments, and then 50% interest to Scott Carson IRA, if somebody wants to do that.
Sure.
Or we'll, depending on the size of the trade, we'll create a special purpose LLC just for that purpose and put them in as a, as an operating or a manager in the operations agreement, so they co-own it. That works a lot, because if people don't want their name and their IRA out in public records, it's a great way to kind of shadow that as well. And so those are kind of the two major facets of things, for the most part. We'll do it. We can also do a assignment of collateral as collateral for a promissory note as well too.
So listeners, you heard that. There's 3 types of protection when you're doing a deal, and Scott does it well. He's done so many of these deals, and you could simply, beyond the assignment, you could have a special purpose LLC, or last but not least, you mentioned that you could also, what was the last one? Was the
assignment of collateral.
Assignment. So assignment of collateral. So basically, it's like you're holding the mortgage. So that's 3 different ways that you can do it, and that's the way you protect yourself. So that's huge. Thanks, Scott. That's some huge tips there for some of the listeners. So guys, one of the things I want to mention to you, we've taken up a good amount of Scott's time, and we really. Scott, I really appreciate having you on here, because you're a gentleman, you're so knowledgeable and very successful. So it's always, for me, the more I talk to guys like you, it's great for myself, great for my listeners, and it's incredible. So some of the things that Scott has going on that I want to mention to the listeners is that he has a book, which it's called. You can go to noteblueprint.com/free book. So you can download that book, learn more. There you go. He teaches you how to buy notes. Download that book. I would really suggest that, even if you're a fix and flipper, you're a wholesaler, you're a buy and hold guy of rentals. If you're a lender, whatever you do. I mean, we're going to talk about all these different investment strategies, throughout the years on this podcast and through the show. But I think it's important to read that book. You'll learn a lot. You even learn about when lenders lend to you, that technically that's a note. So read that book. Scott also has podcasts, so you can go on there and look at the We Close Notes. It's a show, so you can download that through the podcast app. He has free webinars. So if you go to text 72,000, you can get updates on events. You could get updates on deals and webinars.
You got to text the word notes to 72,000. So text the word notes.
Text the word notes to 72,000, and you get updates on events, deals, and webinars. And last but not least, you could also go to his website, which is weclosenotes.com. And you can reach out. He has a staff, and if you want to talk about something in particular, find out about events that are coming up. Scott used to travel so much. I mean, he was one of the biggest travelers. I think that every time I would text him or call him, he's in a different city or state, so he's always traveling. So someone, he has an office, a staff, so they'll get back to you. But I know he does have events, and you could find out about those. When he does have them, or when he's speaking somewhere. So that's important. But, listeners, I hope you got a lot out of it. I sure did. Scott Carson, thank you so much for being on this show, on the Unique Wealth Education Show. It's been a blast. And, one thing I want to ask you, will you join us in another 6 months or a year to talk a little bit more? Because I'm
totally glad to help out, Mike. I echo everything you said, man. I love you. Love what you're doing.
Likewise, buddy.
We don't spend as much time together as we should, because we were both running big things. But anytime we get a chance to hang out, I always walk away with something.
Absolutely.
Really applied.
Absolutely.
So yes, be glad to come back anytime you want to have me. I'm honored to be here.
Scott, you're a great friend. I appreciate you very much, and we'll hopefully talk to you soon. Listeners, thank you for listening to the podcast, and we'll hopefully catch you on the next one.